The previous quarterly video was recorded the day after Liberation Day, and who would have guessed what kind of quarter it would turn out to be? In this video, we will walk through Sifter's second quarter highlights, top gainers and decliners, changes in the portfolio, and which company was completely sold to make room for a better one. Welcome aboard! The second quarter of the year started with a sharp decline due to fears of trade war. The market correction was swift, but so was the recovery. April began on pessimistic note because of Trump's tariff threats. By May, investors' appetite for risk had returned as tariffs were postponed and some trade deals were reached. The value of the fund rose by 5.3% during the second quarter, and year-to-date performance stands at minus 3.0%. Let's take a look at which stocks helped and which ones hurt the fund's performance in second quarter. Welcome, Olli.
Thank you. So, indeed, if we look at sectors, information technology definitely was the sector that performed the best in the Sifter portfolio, return of about 23% on average. And, well, obviously, information technology stocks did well globally also, but our selection was clearly outperforming the sector as a whole, and that's because we have chosen to have a kind of a clear overweight in these semiconductor equipment manufacturers, and those performed particularly well. So that's the big factor that supported the performance.
All right. What other factors lifted IT stocks?
There was kind of a handful of factors. So, a lot of them, pretty much all of them, are tied to the actions of the Trump administration. Semiconductors were exempt from tariffs, and then also a lot of electronics, such as smartphones, were also exempt from tariffs. So that alleviated a lot of the fears that investors had. And then there was some AI-specific optimism also. For example, the Trump administration is rolling back some of the AI chip exports that were set during the Biden era. It still doesn't mean that you can ship them freely to any country, but there's more room for negotiation, more of a flexible policy. And then another point which kind of supported AI optimism is that the Trump administration clearly would like to limit states' ability to regulate AI. That's kind of a tough call. We'll see whether that proposal goes through, but that's clearly their intention. And well, if we look at some data where we could see this optimism regarding AI maybe kind of ticking up, well, we can look at the forecasted capital expenditures of these companies which build large data centers, and a lot of the investments are linked to AI. We can see that forecasts for 2026, they ticked up during the second quarter, so not down. Despite all the economic uncertainty, the expectations were just even increased. So there's some kind of tangible evidence of optimism.
So which were the top gainers then?
Top gainers were all semiconductor companies, as you might expect. BE Semiconductors, Disco Corporation, and TSMC. So not a big surprise.
Okay, yeah. Good. Well, not all companies or sectors gained in the second quarter. So which were the declining sectors and perhaps the companies in those sectors?
Yeah. The common denominator for a lot of the not so well performing companies was that they were healthcare companies. That sector performed the worst in the Sifter portfolio, so 9% decline on average in the share prices, and that just reflects how the global equity, what happened in the global equity market overall. So healthcare stocks suffered, and the reason is that the sentiment deteriorated, and that again was heavily linked to what Trump administration was doing. So clearly their intention is to push the drug prices in the US to closer to what they are abroad. And then also this budget proposal, it would include significant cuts to U.S. public healthcare spending. So a lot of negative signals. We'll see what the actual impact is, but not a lot of good news, I would say. And yeah, you asked about the companies also, and the specific companies. Well, if we look at the bottom 3 companies in the Sifter portfolio, well, Johnson & Johnson was the worst one, but they also had some company-specific issues. So these talc litigations, they don't seem to be able to escape those. It's hard to estimate how much they eventually would have to pay for the damages that they potentially have caused. But yeah, we chose to reduce Johnson's weight in Sifter portfolio for these reasons. See, the downside is kind of difficult to estimate with that case currently.
Yeah. So that's quite typical Sifter risk mitigation.
Yes.
When the company's outlook, especially risk, are not quantifiable, it's difficult to put any numbers. So we rather reduce the position than wait and see.
Yes, yeah, predictability is really, really important. And then the other big decliner, West Pharmaceuticals, again, a healthcare company, and then Old Dominion was the third one. But a lot of the decliners were indeed healthcare companies this quarter.
All right. Well, let's move on the changes we made during the second quarter to the Sifter portfolio. We sold entirely one of our long-standing company, and then we replaced it with a new high-quality company. And in top of that, we conducted quite a few smaller adjustments in the portfolio. Yes. So let's start with the one we sold entirely. So which company we decided to sell?
Yeah, Autoliv. So this manufacturer of passive safety equipment for cars, so airbags and such. The problem there is that the company has limited growth potential. So if we look at what's forecasted in terms of production volume for light vehicles, I mean, the volumes are not going to increase all that much by 2030. And it also seems to be so that the Chinese manufacturers, particularly BYD, will probably capture a large share of that growth. And that's a problem for Autoliv because BYD tends to make their own safety equipment. Now, Autoliv is very attractively valued, it seems so, but kind of we fear that it's a bit of a value trap. I mean, if your top line doesn't grow, might even decline, I mean, no matter what you do with your margins, eventually you will hit some kind of a ceiling with your profits. And we thought that this was a good opportunity to exit this.
Yeah, definitely. And then we decided to exit, and we had also analyzed one company which is really interesting, and then we decided to allocate the money from the Autoliv to this company. So what is the new company now in the portfolio?
Yeah, it's called IDEX, so a US-based company, and it's the only kind of a significant pure player in pet diagnostics, and that's the pet diagnostics. That's a $5 to $6 billion market, and this company dominates that. I mean, they have a really broad offering, which includes testing equipment, but then also laboratory services and the software, which integrates really well with all of this. And they have significant competitive advantages also because the customers, which tend to be small clinics, they require a broad, full offering. And IDEX is one of the few players that can really deliver that. Also, the customers tend to be tied to IDEX through fairly long contracts, so it's not easy to enter the market. I mean, the hands of the customers are tied to some extent already. And a lot of the revenue is also recurring, so this is a fairly predictable company.
So IDEX meets quite many of our quality criteria, and also the historical figures have been very convincing. And we expect the company to continue the earnings growth in the coming years.
Yes.
So high barriers to entry, recurring revenue, nice lock-in effect with the customers, multiple of good things.
Indeed.
We will tell more about this company later in this year. However, we could go through the smaller trade-off, the changes in the portfolio. So which companies we decided to reduce the position and why?
So we reduced, first of all, Johnson & Johnson, as I said. So now it's only 2% of the portfolio. There are things in Johnson & Johnson that we like. I mean, they have a fairly well-diversified portfolio, which provides stability and some reasonable growth. But this issue with the talc litigations is not going away and seems to be intensifying. And we can't accurately forecast the downside there. So this is we're not so thrilled about this case anymore. The risk-reward ratio just isn't as good as it was. Looking longer term, there were better opportunities elsewhere. So we reduced Northwest and Costco a little bit, and we allocated the funds to some more, slightly riskier companies. One was Disco. So with Disco Corporation, we understand that this year is going to be a year of somewhat slower growth than in the past few years, but we think that that's going to be temporary. So the fast growth driver in recent years, or in the past 2 years, has been AI-related demand, which is 15% of revenue, but a bigger part of profits. And it has been growing really quickly. This year, there's probably not going to be that much growth because the type of demand that Disco gets when it relates to AI-related revenue is really linked to high bandwidth memory, which is a specific type of memory that AI chips require. But last year, there was such capacity increase in high bandwidth memory that the market is kind of digesting it this year. But still, if we look at TSMC's long-term forecasts in terms of how much revenue they expect to earn from making AI chips, it's clear that the investments in AI chip manufacturing capacity, including high bandwidth memory, should increase. So TSMC expects something like a 45% annual growth in terms of their AI-related chip sales.
That's extreme. And
over the next 5 years.
And TSMC is Disco's biggest client as well.
Yeah, when it comes to this AI related revenue, it's a big player. Though high bandwidth memory is manufactured by memory manufacturers such as Samsung, Micron, and SK Hynix. But TSMC is a big player in that supply chain.
Right. Yeah. And so we can see potential correlation there when TSMC is growing the earnings and in this area. And so Disco might benefit a lot from that.
Yeah.
Excellent. And the other one, other company we increased the position is a company which we have held for since 2020. It's a Novo Nordisk, and very often we are asked that what is our insight regarding Novo after owning it for a long time, and now the stock price has been under pressure for this year and a previous year. So I think that actions speak more than insight. So what was our action regarding Novo share?
Yeah, well, we increased Novo share in the portfolio, and the reason for that is that, well, although the recent trials do indicate that the Novo's kind of next generation GLP-1 drugs might not be clearly the best ones on the market. We still believe that Novo will continue to be one of the leading companies in weight loss drugs in general. So they should still be a relevant and strong player in that market. And the stock price has already dropped significantly after these trials, and it's just currently the valuation looked attractive to increase again.
Yeah, that's a fair reason, and if we think about the underlying growth in the obesity market, so we have Eli Lilly and we have Novo Nordisk, and they are kind of like oligopolistic situation now. There will be competition, of course, but still the underlying growth is huge. And we know that Novo is one company which has a very long learning curve. They are specialized on not only one thing, but they are very good at what they are doing.
Indeed.
So that kind of like convinced us. The third company we increased the position is Deutsche Börse, and it's one of our best performers also this year when it comes to share price. Why did we increase also Deutsche?
So Deutsche Börse, well, they have like 3 long-term tailwinds that support them, and one is the increased capital flows to Europe. The second thing is that the public investments in Europe are growing, particularly in Germany. So that will kind of stimulate the economy and also lead to more debt issuance. So there's more debt securities being traded around. And the third thing is just the EU aims for a more kind of a harmonized capital markets. And for a big player like Deutsche Börse, that should also be a benefit. So kind of a big, longer-term tailwinds supporting that company.
Okay. So three companies in which we increased the position a bit more than the others. Very good. So let's move to the third topic, which is the core of this Sifter investment principles. It's earnings growth. If you think about the current situation where there's a lot of turmoil in the markets and there's a fear in almost all the news, so there must be one thing in which we rely on, and it's the earnings predictability. And one thing what we don't kind of like follow the valuation ratios or multiples. That's something we don't want to analyze or predict, but the other thing is what we do is to analyze the earnings growth and the potential and predictability of the 5-year earnings growth. And you have 2 companies in your mind you would like to share, which are typical examples of Sifter companies where we have had historical earnings growth, and also we can rely on the next 5 years earnings growth, at least in some quite good manner to believe that they will implement the growth. So the first company is which?
Microsoft. Yeah, Microsoft probably doesn't need an introduction, or that's what we generally think. Everyone has heard about it, but the company has changed a lot over the past decade. So really, the kind of the old impression of Microsoft was probably a kind of a big tech company, but kind of experiencing slower and slower growth and a kind of failing to build new significant successful businesses. But kind of the company has been revitalized thanks to their entry to cloud computing services in a big fashion. So essentially, they provide cloud computing services over the internet, utilizing their own data centers. So that's the big picture. And now over half of Microsoft's revenue and essentially all their growth, if you look at the past few years, has come from these cloud services, which are directed to kind of corporate customers, commercial customers. And the offering is very broad. So it includes the basic infrastructure as a service. So just the computing capacity and storage capacity, but also kind of platform as a service type of offerings. So kind of tools to develop cloud-based applications, things like that. Then they also have a strong offering in software as a service. So obviously the Office productivity package, the cloud-based version of that is also successful. And over the past 5 years, profits have grown at about 20% annual pace, and the market capitalization has kind of followed the similar trajectory. So really good track record.
20% for such a big company over the years, extremely good growth.
Yes.
And they are able to innovate new products and services and make it really profitable. But first they had to invest also.
Yes. They are investing a lot still. And obviously our forecasts are conservative in a way that we do expect slowing growth. I mean, the laws of gravity, do affect this company at some point. But still, right now, there doesn't seem to be any obvious point why the growth should stop. So the growth has come from if we look at the infrastructure and platform as a service, so it's just the increased adoption rate of these services, and also the growing consumption of the resources, storage, computing, and the fact that customers have been building more kind of software infrastructure that relies on Azure. And if we look at software as a service, the Office package particularly, so the adoption rate of that has grown, but also the price of it has continuously ticked upwards. So they are just really successful in offering more add-on services, whether it's about security or productivity or whichever, and just charge higher and higher prices.
So what kind of earnings growth do we expect and analyzed for Microsoft for the next 5 years?
Yeah, about 10% annual profit growth, of operating profit growth over the next 5 years. The adoption of cloud computing probably will increase. The consumption of the resources there will probably increase, and it's hard to see why their price hikes in the cloud-based Office offering would suddenly stop. They have been pretty consistent in delivering price hikes.
And how does our earnings expectations compare to market consensus?
The market consensus expects like a 15% profit growth over the next 5 years, so annually 15%. And one reason why there's that difference, or why we seem so conservative, is that we don't really make forecasts regarding AI-related revenue or profits. So it's a really small part of our kind of forecasting model, because there's just not track record yet of it supporting really either of those profits, particularly AI-related revenues right now only 5% of Microsoft's total revenue, and indeed, as you kind of alluded to, the investments, that's where AI is visible. So a significant portion of the investments that Microsoft does is linked to kind of enabling that AI revenue to grow. So essentially servers that have capabilities of kind of running large language models. So they're buying a lot of those. And the investments are kind of significantly higher than the revenue that those AI services currently generate, but that's how it was when Azure was beginning its journey.
Yeah.
So I still wouldn't see that as too much of a red flag.
So we have seen these Azure investments as well, since we invested in Microsoft already 14 years ago. So the fund has been now established since 2003, and the Microsoft investment was done after the financial crisis. So it's a long journey together with this boring but growing company, and we really like it. But then the other example is totally different kind of business model from the different sectors, and it's also one of our most recent investments. So which company you would like to share?
Yeah, Cintas. So that's also an American company, but very different, not so high tech. So essentially, they are the market leader in uniform rentals in the US. So a dominant company in that field. And the profits have grown at a 12% annual pace over the past 5 years, and the market capitalization has kind of followed the same trajectory. And it's pretty impressive, and the growth comes from many sources. So it's consolidation, that they are consolidating the market, taking market share organically and buying smaller players. And also the profits are growing, and revenue and profits are growing due to their ability to sell add-on services. So Cintas personnel will visit the customer location anyway when they bring the new uniforms and take away the dirty ones for cleaning. So there's a good opportunity to sell those kind of little services which customers would like to outsource, usually related to safety, fill the hand sanitizing stations and check the first aid cabinets, everything is okay there.
And this niche market where the Cintas operates, it's quite fragmented, isn't it?
Yes, indeed. So this company, even though it's clearly the biggest one, only has like 18% market share, and the second biggest company is like only a third of Cintas' scale. And once you account for the three biggest ones, the rest of the market is really fragmented. So these kind of a giant can leverage some scale economies there. They often have a fairly dense customer network. I mean, it just gets more and more efficient the more customers you have there. There isn't that, you don't have to travel that far in order to reach the next location when you do that regular tour across the customers to kind of fill the cabinets or whatever you need to do. Yeah. Other ways that the scale economies can work in their favor is just the purchasing of the uniforms. I mean, they can purchase a lot in bulk and just leverage their purchasing power there.
Yeah. And even though it's a really very much different to Microsoft as a business model, but then it's possible to find a company which is growing so steadily. If you look at the graph and the earnings growth in the last decades, it's been really nice. It's like a school book example. And we also expect the company to continue the growth. Let's move to the next topic. And as an investment manager, we have two goals. One is to identify, analyze, and finally invest in high-quality companies where there's earnings growth and predictability. Well, the second goal is, of course, to keep the portfolio valuation on moderate level. So, Olli, how do we expect the portfolio earnings growth to be growing and in the next 5 years? And how do you see that?
Yeah, so we updated all our long-term forecasts at the end of May, and the average revenue growth that we now expect is slightly over 7% per year over the next 5 years, and the operating income to grow at about 8% per year over the next 5 years. That's a little bit more conservative forecast than what we had earlier. So we have slightly adjusted downwards our estimates regarding Novo, Disco Corporation, and BE Semiconductors, but still healthy growth on average. Obviously, there's a fairly wide range of forecasts that we have for different companies. So some are growing significantly faster, some much slower, but still for all the portfolio companies, we obviously require growth. Otherwise, it doesn't fit our strategy. So we expect all the companies to grow at least somewhat over the next 5 years.
Yeah. And I would say that as an investor in the fund, I feel much more safe when we have defensive quality company and not only the hyper growers. Because typically the very high growing companies, they had valuation multiples are extreme. So it's a good balance of having a different kind of quality businesses. But at the end of the day, there's like roughly a bit more than 7% expected growth. And we are conservative. If we look at the market consensus, that would be perhaps 10. But nevertheless, we prefer to be a bit more cautious than the market. So
and this combination of slower and faster growing companies allows us to take advantage of these kind of special market situations where the investors might be overly excited or overly cautious. So we can kind of balance our investments between these different kinds of investments because we can't do any other kind of balancing because we don't have cash. We are all in equities.
That's correct.
So this having different kinds of equities there allows us to.
How about our second goal as a portfolio manager to keep the portfolio valuation on moderate level? So how have we succeeded in the previous year?
So we use the earnings yield to assess the valuation. So what that means is that we forecast the earnings per share for each portfolio company 5 years into the future. And we take that 5th year earnings and compare that to the current share price of that company. And that's the earnings yield. So the average earnings yield for the portfolio at the end of May was 5.1% and still roughly around that region. Yeah, that's pretty well in line with the past 5-year average. So from the historical perspective, I would say that the portfolio is pretty balanced. So it doesn't seem expensive expensive or cheap based on this number.
Even though share prices has risen roughly 80% in the last 5 years, but when you look at these, our valuation has remained on the average level.
Yeah.
And that's maybe the secret, that whenever some companies or stocks, the price gets too pricey, so we reduce the position and replace it with a little bit cheaper one.
Yes, yeah. We do these adjustments on like 1 to 3 new companies in the portfolio per year, and obviously a similar number also exiting and little adjustments also. But also one big factor why the valuation has remained kind of attractive in that 5% region or so, despite that share price increase, is just that the profits increase almost every year on average. So that just gives some, that kind of limits the valuation, kind of helps it keep in a reasonable kind of window.
Right. But if we expect the earnings to grow roughly 7%, hopefully even more percentage on an annual basis. So in a long term, we could expect that the share price will follow the earnings growth. And that's the simple recipe, so to say.
Yeah, as long as the earnings multiples stay stable. But forecasting those is really a different science.
Well, that's something we don't do that. Yeah, we don't try to predict the earnings multiples or the market momentums. That's we concentrate on the couple of things. One is the predictability of the business model, and how about the earnings growth, and also the quality of the business as such. And this disciplined process and strategy has helped us in the last 22 years to perform quite nicely, to be honest. After all the fees, we are still doing better job than most of the indices and peer funds. And that's a long-term quality investment strategy we rely on. We wish you a very good summertime and hope to see you again in August. Thank you.
Thank you.